Welcome to the Deep Dive. Today we're taking a pretty crucial look into the U.S. housing finance system's core, our source material. It's Fannie Mae's third quarter 2025 financial results, straight from their recent earnings call remarks. Now, we know these reports can be, well, dense, lots of jargon, lots of numbers, easy to get lost. But our goal here is simple. Give you the shortcut. Want to boil it down to the really essential stuff, basically understanding Fannie Mae's financial strength, and also the challenges they're seeing, around credit and affordability right now.
That's exactly it. Fannie Mae is just this massive engine for mortgage liquidity in the U.S. So when they talk, people listen. For you, listening in, think of this as an economic checkup. We're trying to see what makes them resilient financially and, frankly, where the market's feeling the pinch from higher interest rates.
Okay, so let's start with some immediate context. There was actually pretty big news right off the bat this quarter. A leadership change. Priscilla Almodovar left as CEO. And Peter Akubo was named acting CEO. That came from the CFO, Chrisa Halley, during the call.
Right. And in moments like that, transition periods, the key message is always stability. The company made it really clear their focus hasn't shifted. It's still about, disciplined risk management, being efficient, and using those strong earnings to build up capital. That's the mission, regardless of who's at the helm.
All right, let's get into the numbers then. The core financial performance for Q3 2025. What were the headline figures? The bottom line.
The bottom line looked pretty robust, pretty consistent. Net income for the quarter landed at $3.9 billion, and that's actually up quite significantly, 16% from Q2 this year. So good momentum there.
Okay, 16% up quarter over quarter sounds great, but I did notice it was actually down a bit compared to last year, Q3 2024, about 5%. What drove that?
Yeah, that's a good catch. And it's important context. That year-over-year dip wasn't really about core revenues falling off. It was mostly driven by changes in their provision for credit loss.
Provision for credit loss. Okay, can you break that down quickly?
Sure. Think of it like this. It's the money Fannie Mae has to put aside now based on predictions about potential future loan losses or defaults. So last year, maybe their outlook meant they set aside less. This year, maybe the risk models suggested setting aside a bit more. It's really an accounting adjustment tied to forecasts, not a reflection of, current income drying up.
Got it. So it's more about managing future risk than a present problem. And despite that adjustment, profitability is still letting them build up their balance sheet. They mentioned that metric, the illustrative return on required equity. That ticked up to 10.3%.
Exactly. And all this consistent earning power, it adds up. Their total net worth has now hit $105.5 billion, which is, substantial. And when you look at where the money's coming from, you really see the strength of their basic business model.
Tell me more about that model. What makes it so resilient? We hear about guarantee fees.
That's the core. Their net revenues were stable at $7.3 billion for the quarter. And here's the key part. Nearly 81% of that came from stable guarantee fees.
Okay, let's pause there for a second. For anyone maybe not deep in mortgage finance, what exactly are guarantee fees? Why are they so crucial?
Right. So imagine a bank makes a mortgage. Fannie Mae might eventually buy or guarantee that mortgage, packaging it up for investors. In doing that, Fannie Mae takes on the credit risk, the risk the borrower might not pay it back. The guarantee fee is essentially the insurance premium they charge for taking on that risk. It's a small percentage charged ongoing, but because their total guarantee book, the amount of mortgages they back, is enormous, like $4.1 trillion right now. Those small fees add up to a huge, steady income stream.
Okay. So it's like a subscription fee on trillions of dollars of mortgages. Makes sense why it's stable.
Exactly. It comes in pretty consistently, month after month, whether rates are high or low. That's the durability.
So that explains the consistent income. Now, how does that financial stability translate into their actual market impact, for regular households in Q3?
Well, that steady income engine fuels market liquidity. In Q3 alone, Fannie Mae pumped $109 billion of liquidity into the mortgage market. Just think about that number. It's massive.
Wow. And where did that $109 billion go?
We can see the breakdown. It helped over 400,000 households. And digging into that, about 207,000 were home buyers. And here's a really interesting stat. About half of those home buyers, so over 100,000, were first-time buyers. That really highlights their role in, keeping the door open for entry-level buyers, even when things are tough affordability-wise.
And it's not just buyers, right? They also play a role in keeping people in their homes.
Absolutely. They helped over 23,000 households avoid foreclosure in Q3 through things like loan modifications or other assistance programs. If you zoom out for the year so far, they've helped about 1.1 million households in total. It just shows the sheer scale we're talking about.
Okay, let's circle back to that core engine. the $4.1 trillion guarantee book. You mentioned affordability headwinds. Is the book growing right now?
It's facing pressure. High rates are definitely a hurdle for single-family buyers. What's happening is the base guarantee fees on new loans coming in are a bit higher, reflecting current rates. So the book is slowly turning over. But they're not bringing in enough new loans right now to fully offset the runoff. You know, older loans with lower rates getting paid off or refinanced out eventually.
And that leads to the mix of business, right?
Yeah.
What kind of loans are they actually acquiring?
Yeah, this is telling. In Q3, a full 80% of their single-family acquisitions were purchase loans, people buying houses. Only 20% were refinances. Which makes sense, right? When rates are this high, who's refinancing?
Do they give any indication about when that might change? Like what rate level would actually trigger a meaningful wave of refinancing again?
They did, and this is a key signal for anyone watching the market. Based on the interest rates of the loans currently in their portfolio, they said they don't expect any significant pickup in refinancing unless mortgage rates drop below 5%.
Below 5%. Okay, so that's the magic number, the threshold to watch.
Seems like it. That's the tripwire, yeah.
All right, let's shift gears a bit and talk credit performance. Overall picture seems stable, which is good, but are there differences between, say, single-family homes and multifamily properties?
There are. And the pressure point is definitely showing up more clearly in the multifamily segment. We're talking apartment buildings, rental properties. There's seriously delinquent loans and non-performing loans in multifamily actually ticked up by 7 basis points just from Q2.
Okay, 7 basis points. Remind us, how significant is that? Is it a huge jump?
It's not huge, no. A basis point is tiny, 1/100%. So 7 basis points is a modest move, but it's a noticeable increase. It signals growing stress in that sector. The reason they cite it is basically accumulated pressure. You've got rising operating costs for landlords, insurance, taxes, maintenance hitting at the same time as rent growth is softening a bit, so it squeezes their net operating income, the profitability of the building.
So it's less about massive tenant defaults right now and more about the economics for the property owners feeling tighter.
That seems to be the main driver, yeah. Contrast that with single-family homes, which is, their main business.
How's that looking?
Remarkably stable, actually. Seriously, delinquent loans there only increase very modestly. Borrowers seem to be holding up well overall. However, they did flag something interesting about the new loans they're acquiring.
Ooh, makes that.
They noted a slight upward trend in the percentage of new loans with FICO scores under 680, and importantly, debt-to-income ratios DTI over 43%.
Okay. Higher DTI. Should that worry us? Does that mean they're loosening standards like back in the day?
That's always the fear, right? But Fannie Mae offered some important context here. They suggested this is mostly an outcome of the current market, specifically the high proportion of purchase loans. Think about it. If you're buying a house today with these rates, you're likely stretching your budget to the absolute limit just to make the monthly payment work.
Right. So buyers are naturally coming in with higher DTIs just to qualify in this environment.
Exactly. They explain that new home buyers tend to enter near their affordability ceiling right now. So they actually expect that slightly higher DTI trend in new purchases to kind of stick around until rates come down significantly and maybe refinancing picks up again, easing that payment burden.
That makes sense. It's a symptom of the rate environment more than a change in underwriting philosophy, perhaps. Okay, before we get to the really big picture on capital, a quick note on expenses. They seem to be managing costs well, down 8% quarter-over-quarter, 10% year-over-year.
Yeah, that efficiency focus was pretty clear. It came from a couple of places. One, lower administrative costs, things like salaries, benefits, paying for outside services, partly because they reduced their employee and contractor workforce. And two, they had some gains from basically buying back some of their own mortgage-backed securities, which cleans things up financially and counts as a gain on debt extinguishment. Smart moves.
All right, let's pull it all together now. The big overarching goal for Fannie Mae, meeting those regulatory capital requirements. The numbers involved here are just huge.
They really are. And you have to acknowledge the progress they've made. They've increased their net worth by $92 billion just since the start of 2020. That's a massive buildup.
Yeah.
But there's still this regulatory capital deficit. At the end of Q3, it stood at $25.4 billion.
Wait a minute. How can they have a net worth over $100 billion but still have a capital deficit of $25 billion? That sounds contradictory.
It does, but it comes down to the specific rules about what counts as regulatory capital. The simple version is not everything on their balance sheet qualifies. Specifically, 2 big items don't count towards that requirement: the senior preferred stock they owe to the Treasury from the bailout days and their deferred tax assets.
Okay. So the net worth is real, but some big chunks of it can't be used to satisfy the regulator's capital demands.
Precisely. So those retained earnings we talked about, the $3.9 billion this quarter, they are helping build eligible capital. But because of those exclusions, the total target they need to hit is much higher. As of Q3, Fannie Mae needs about $190 billion in total eligible capital to meet all its requirements. So that $105.5 billion net worth is great, but the regulatory gap is still substantial.
$190 billion target. Wow. That puts the $25.4 billion deficit in perspective. Still a long way to go, even with strong earnings. Did they mention anything about stress tests? You know, the what-if scenarios?
They did. The results from the 2025 Dodd-Frank stress test were mentioned, and the takeaway was pretty positive, actually. The test simulates a really severe economic downturn worse than the 2008 crisis. And even under that extreme stress, the results showed Fannie Mae could still function and support the housing market. It suggests their current risk management is quite robust, giving them breathing room to keep building that capital.
Okay, so wrapping up our deep dive here. If you had to pick two main themes from these Q3 results, what would they be?
I'd say, number one, resilience. That consistent $3.9 billion in net income really underscores that. And number two, durability. The guarantee business, those fees, just form such a stable foundation for revenue, even in a tough market.
And looking forward, what's the key tension or dynamic for you, the listener, to keep an eye on based on this?
It's really the contrast, I think. You have the single-family book, their core business, performing very steadily, almost predictably, very robust. But then you have this focused emerging pressure point in the multifamily segment, specifically with property owners getting squeezed on income. Watching how that evolves seems key.
Right. Okay, here's a final thought for you to chew on as you process all this. We heard that huge $190 billion total capital requirement. And we know retained earnings are the main engine for getting there right now. So the question is, how long would it take? How much does the housing market need to stabilize? Or maybe how fast do rates need to drop below that 5% mark we talked about for retained earnings alone to realistically close that remaining $25 billion regulatory gap? It's a big number to fill just from profits. Something to ponder after this deep dive.